Most founders think they have a financial plan. What they actually have is a budget they built in January, bank balance they check on their phone, and nothing in between. This video is about why that gap is where most financial decisions go wrong. I'm Philip. I help service founders read their numbers. The consensus is wrong. Here's what most financial advice tells founders to do. Build a budget at the start of the year, set revenue targets, plan your expenses, know what profit you're aiming for. That is correct. And it's also one half of the picture. The mistake is treating the budget as the only financial planning tool. A budget and a cash forecast are two completely different things. They answer two different questions. And most founders have one or neither and think they have both. What a budget actually does. A budget is the plan. You build it once at the start of the year. It sets targets for revenue, income potential. It defines the expenses needed to run the business, the cost to produce the service, which includes things like labor and materials, plus operational costs like rent, marketing, and payroll. And it builds profit into the model from the beginning, not as whatever is left over at the end of the month, but as a planned number the business is designed to hit. The budget answers one question. If everything goes according to the plan, what does this year look like? What a forecast actually does. A forecast is updated reality. It's the closest thing to a crystal ball that exists in business. You build it monthly against what actually happened, what revenue actually came in, what is realistically expected to arrive the next 90 days based on what you know right now, what expenses are actually committed, what obligations are leaving the account, payroll, quarterly taxes, loan payments, and when exactly do they hit. The forecast answers a different question. Based on what's actually happening right now, what does the next 90 days look like? Most founders are only checking their bank balance. The number has zero context. It does not tell you what is committed, what's coming out, or what needs to be reserved. They end up leading off of vibes instead of information. A cash forecast changes that. The difference in practice. Here's the clearest way I know how to explain why you need both. A budget tells you whether you plan to hire someone in Q3. A forecast tells you whether the Q3 cash will actually support that hire when the time comes. Without a budget, you have no standard. You do not know if you're on track or drifting until the year is already over. Without the forecast, you're making real business decisions off of plans you wrote 6 months ago. Revenue has shifted, expenses have moved, but the budget has not updated. It still says what January believed. Real client example. I worked with a med spa client that had reoccurring memberships and strong demand. The owner had built a budget at the start of the year, but every month, cash kept surprising her. When we dug in, there was no cash forecast. She knew what the year was supposed to look like. She had no visibility into what the next 60 days actually looked like based on what was really happening. A good example of how a forecast changes decisions, we identified that the business had a seasonal slowdown historically. Instead of hiring during those slow periods and carrying that payroll cost through the quiet months, we delayed hiring to the point where revenue would support the new expenses and they could train properly. This is the difference between a plan and a forward-looking picture. One tells you the intention, and the other tells you the timing, what a 13-week cash forecast looks like. A 13-week cash forecast is the most practical version of this tool for service businesses. You map out 13 weeks of expected cash in and cash out. Not what you hope happens, what you actually know is coming in based on current contracts, payment terms, and obligations. Cash in, what revenue is contracted or expected, and when it is actually expected to arrive based on the collection terms. Cash out, payroll dates, taxes due, loan payments, vendor obligations, every fixed commitment mapped to the week it actually leaves. The gap between cash in and cash out each week tells you your real position, not what the bank shows today, what you will have available in 30, 60, 90 days from now. When a business owner has a real cash flow plan, their confidence goes up and their anxiety goes down because they can actually see into the future. They can build scenarios, they can delay, they can adjust and plan instead of reacting to whatever the bank account shows when they open the app. The bottom line, a budget without a forecast is a plan you set and forget. A forecast without a budget has no standards to compare it against. You need both, and most service founders have neither. The ones who do have both make different decisions, not because they are smarter, because they can see more of what is coming before it arrives. In closing, if you have a budget but no forecast, or a forecast but no budget, or neither, start this week. Subscribe for more on what financial clarity actually looks like in a service business. And if you want help building both for your numbers, the link below is where to start.